So, welcome to today's podcast. I'm really excited to kick off what I think is going to be a hugely valuable tool for you as you think about your personal finances and the freedom that hopefully it can provide for you. That's the thing that we really harp on this podcast, and hopefully you also subscribe to it, is wealth is a tool that helps us live our best life. Us the freedom to hopefully do the things we want for ourselves, our families, and others. So, unfortunate reality is that there's a lot of things to learn about to build that freedom. And so today we're kicking off a series here. I have a friend of mine, Joe DeFazio, has a wealth of knowledge around finances and is an enrolled agent, which we'll go into that if you haven't heard that a name before. But we're going to go through a series that talks about taxes, and it's not a topic that I think most people love to talk about. I actually enjoy talking about it in some respects with the right people, but it's one of those areas that, just like that concept of death and taxes, they're inevitable aspects of our lives. Death is something we're all going to face, but taxes depends on your situation. There are cases where you might be able to not pay any taxes and still be doing good in this world. So, Joe, I really appreciate you spending time and lending your expertise in this world to help others just learn about a topic that I think is a little confusing for people. So, thanks for joining me.
Absolutely. It's a pleasure to be here. Thanks for having me back. Yeah, I'm excited to get started. Man, in that vein, it's hard to believe. Most people don't know that taxes weren't always here in America. Like America operated without taxes for a long time. It wasn't until it was 1862 for the Civil War that the first tax, like income tax, which was repealed 10 years later, didn't have support. It was unconstitutional, what have you. But uh, for a long time, it didn't operate it, and then for another long time, all the way up to 1913, it did. There was no income taxes as we know it today, and wow, did it balloon since then. But yes,
Yeah.
understanding it is so important. Like, sorry, go ahead.
Yeah, no, but that's right. I mean, it's one of those things that, and you know it better than most people, it's very complicated. And so, just like a lot of things are complicated in life, we want to avoid those things. So, you as a listener, if you listen to this, if we're going to try to simplify this, as part of a series here, just to give some foundational pieces is what we're going to cover mostly today. But, through the course of this series is to share more detailed aspects of the tax code, and even strategies around how to mitigate taxes legally. I don't know about you, Joe. I'm not, I don't envision myself in cuffs or orange anytime soon. So, what I want to make sure to do is to give the facts around the tax code and how to use it for your benefit. And ironically, for some people, like you're actually supporting this government and what it's trying to do in this world, right? So you can do good and save on taxes, which to me is the epitome of a win.
And if you didn't know, if you feel obligated to pay more taxes than your that shows up on your 1040, there is a donation. The IRS website has a
Yeah,
donation where you could just put whatever you want in there. You can throw more money if you'd like, if you so wish.
yeah,
So,
yeah.
um,
I wonder how many people actually have utilized that. Maybe some people have. I've never come across anyone who's actually did anything with that, but nice to know. Nice to know if you
Tom,
don't feel like you're giving enough.
yeah, when I found it, I thought it was a joke. I was like, are you kidding me? Like, the IRS has a GoFundMe page. Oh goodness. Oh
Yeah, well,
goodness.
listen, in this day and age with the constant deficits they run and building of debt, they could use any dollars they can get, right? I think to
Yeah.
help fund what they're doing here. So we won't go too crazy with that. But, it is interesting. And then there's a way to think about it that is certainly more positive. And certainly I think we all, hopefully you as a listener here, you love this country just like Joe and I do. And we want to support it and grow it and live a great life here. And I certainly feel fortunate with it. So this isn't about trying to just keep more for ourselves, but my hope is that having more wealth here helps you do what you do best, right? To grow your business, your life, and families, and then maybe support things that you actually care more about, right? And you can impact in a positive way. So that's the angle we're trying to take with this. It's not all evil type things, right? This is more positive. So hopefully you
Uh,
can get some benefit out of it.
Well,
Um,
Tom, for your listeners, it's important to know before we kind of jump into how to mitigate some of these taxes. There is no law that requires a US citizen to arrange their financial affairs in such a
Mm,
way that you pay the maximum taxes. There is no law for that. Okay, so this is, as we said, we're not going to end up in handcuffs. We're not interested in orange jumpsuits or anything like that. But the code is there, and it's kind of a manual. Once you start to understand the structure of it and what it's trying to do and incentivize, if you follow the instructions, the government rewards you by relieving some of the tax burden you would otherwise have. And that's all we're trying to do. We're trying to sift through some of this to find some low-hanging fruit that people can take advantage of and hopefully mitigate some of their otherwise tax liability.
absolutely. Right. This is, and as a disclaimer, right, this is education. This is not tax advice or investment advice, but the hope is that we empower you with enough information that you can either go talk to your tax professional if you have one and inquire, right, about things that you might be able to do. But and I've come to appreciate the tax professional sort of world because there's a lot to know, right? It's so can be very complicated and not always black and white. And so I sometimes feel bad for tax professionals. They had to keep up with all this mess and that changes over time and be able to help people. So I know they probably want to be more proactive, but it's sometimes difficult. So we sometimes have to take things in our own hands, right? To learn more and get educated. And that's why I know you're on this podcast, Joe, to help me share this with others. So let's get cracking at it. So when we think about the tax code, and you kind of alluded to it, it wasn't always here. It kind of feels like it's always here, been always here. But so what's really the purpose of taxes anyway, right? When we think about it, maybe where it started and kind of how it's sort of shaped into its current state today.
Yeah, so from all my studying, you can deduce there's four main reasons we have the tax code. Now, everyone jumps to the idea that, or the reason that it's to fund the government spending, right? It's to fund the programs and build the streets and keep the schools running and things like that. Fund the military, fund the education system, fund the healthcare system. That is, in my opinion, the least important reason they have taxes. If you study taxes, again, you learn it's much more of an incentive roadmap than most people understand. So the first thing the government is trying to do is control behavior or influence behavior. If they make something painful by increasing taxes or removing subsidies or removing deductions, people are less likely to do it.
Mm,
Because if you do it, you have to obviously pay this larger tax bill. So, path of least resistance, people are going to go where it's lower tax, like the lower tax opportunities are. So, in that way, they can kind of, I hate to use it's like a negative term, but manipulate the interests of the free market to say, hey, we want investors over here, real estate investors over here, so they might create an opportunity zone. Say, if you invest over here, we'll look the other way when it comes to certain taxes. So then investors will flock over there to try and mitigate certain taxes. So influencing behavior, in my opinion, is probably the number one reason most of the tax code exists. The second most important reason, in my opinion, again, is probably to mitigate what we call inflation. So the government, the only thing they don't produce anything, except dollars. So the only thing they do is kind of shuffle wealth around, right? So in order to expand the system, they have to kind of create more units of currency or dollars. We know them as dollars in America, but they might be euros elsewhere. They might be francs or what have you. In America, the U.S. dollars. If you create too many of these currency units, and all else being equal, there's the same number of goods and services in the economy. Business owners, over time, when they realize it, tend to increase the prices because everyone has more money. And why wouldn't you want larger profits? So to combat that, they put taxes in place. And we know this because if you earn money, you get taxed. You get taxed at a federal, a state, probably your local earned income tax. You get your Social Security, your Medicare, FICA. You get maybe additional Medicare tax. You get investment income tax, long term or capital gains tax. You get sales, real estate, the list goes on. you get taxed at the wazoo. And if I give my money to Tom because he sold me these glasses, Tom now has to pay taxes on it just because it shifted from my bank account to his. And the whole cycle starts. And it's like it just has this compressing impact on currency units. It's like sucking this free cash flow out of the economy so the prices just don't go haywire. There's a new school of economic thought, modern monetary theory, I think it's called, which relies heavily on taxation to control inflation largely. Okay, so that's two. So we got control behavior or influence behavior. We've got control inflation, hopefully, mitigate inflation. And then the third, probably most prevalent, would be transferring wealth, redistribution of wealth. So, not to play any type of party line or anything, just calling it as you see it. What the government is literally doing, they're taking resources away from productive entities or people in the economy and shifting those, redistributing those to less productive people or entities in the economy. And they do that over and over. You could see this through transfers, that is any type of government benefit. You could see this through the funding, now the funding of Social Security and Medicare. You can see this through like insurance programs for underprivileged people or single parent families. You could see this for free lunches. You could see this with utility bills. These are government transfers where they take money from our paycheck or your paycheck and they move that to somebody else who might be less fortunate or doesn't have a paycheck, but they still need these certain things. Now, the fourth reason is what everyone just jumps to in the initial, usually jumps to in the beginning, is to fund government spending. The reason I put it last is because if the government has a printer to print currency units, they don't have to ask anybody to spend money. They have a running tab that they just keep spending. And you know that, I think Tom talked about earlier, we have crazy deficits. Deficit spending is spending money you don't, it's like us spending on a credit card. After your paycheck is gone, your bank account is zero, and you go out and spend on your credit card. That's deficit spending. That's what the government does day in and day out, year in and year out. Um, so
That's
I don't
crazy.
think
And
it,
go ahead.
I was just going to wrap that up with if the government, I don't know the exact numbers, so don't hold me to this, but if the government were to create 100% tax on all income and all wealth, I think it would only fund 6 or 7 months of spending, and then it would be gone. Not take care of the debt, I mean the spending part of it, it would be gone. We'd have no more country. It's taxing, you don't tax your way to wealth. You can't do that.
Yeah, no, and I think in a lot of cases you can easily argue it damages a lot of things as this, in my mind's control, or some people term it manipulation, goes on. It can actually disincentivize people from actually producing and creating stuff too, which is kind of potential harm from some of this stuff, like to your point, the transfer and sort of people getting something for nothing in some respects, in some cases, right? It doesn't allow them to sort of become all they could probably be too, which is always a potential harming the economy broadly. So that's a really great summary of that because, to your point, we probably gravitate towards the last part of it, right, to fund the government. But there's a lot of other things at play here. And in some cases, I always think that the complexity is made for a reason, right, to help sort of confuse people in some respects, right? But I know it's maybe not intentionally that way, but it can be kind of confusing. So help us understand sort of the basics around sort of the brackets because it isn't one tax rate. There's not one for everyone, right? This is kind of a unique model here. So can you kind of share kind of the nuts and bolts of kind of how the tax kind of brackets and rates kind of work?
Well, if you don't mind, I'm going to take a micro step back even further, because I think to understand the brackets, you have to understand which tax we're talking about. Um, and to understand that, we have to understand what type of income we have. And
Hmm.
generally, what the IRS says is called income, which I would throw this out here. This is something crazy. You want to go down a rabbit hole. Try and find the definition of income in the IRS code. And there's quite a few law firms that have the whole thing published that you can sift through and search. But you're going to get to a point where it says income from sources derived, and they're going to give you a list, an incomplete
Mm.
list. And that list, which is someone made a very interesting logical argument. If something is derived from something else, it cannot, in fact, be that something else, right? So if you think about what a derivative is, it's like a portion, or
Yeah.
it's right? So it cannot actually be the whole thing. Otherwise, it would just be that thing. So if you look at the list, okay, now we have a list of what constitutes as income, but what portion of those items is income? But I digress. You definitely look into that. It's an interesting logic exercise to go through. But the IRS gives us, oh, go ahead, sorry.
Oh yeah, but I do want to. I think you hit on a really key point, and this might be a simplistic way, and if you can share this a bit, because it's I always see the cash flow quadrant, right? A rich dad poor dad sort of
Okay.
world where you have people are taxed differently depending on how they're producing, right? How's income coming into their lives? Like we're probably not going to go detail on all of it, but like that is at least helpful to understand kind of how the incentives are pushed to certain ways, right, of operating. So can you walk through from an employee to self-employed to a business owner to almost investor, kind of what that may look like?
Yeah, sure. So maybe we can put a quadrant up so people can see it, but
Yeah.
the quad on the upper left, I think quadrant would be the employee in the rich dad, poor dad quadrants. An employee earns a W-2 wage most of the time. They're going to earn W-2, and all that means is like salary or hourly income. So it's earned income. You have to be present and physically trading your time and energy and efforts and ingenuity for some type of remuneration, some type of regular pay. Earned income. So ordinary income. That will be subject to income taxes, both at a federal, state, and probably an earned income local level. So earned income is taxed on a progressive scale. So all that means is every dollar is not treated equal. The more you earn, and there's varying brackets, which we can go through a little bit later, but the more you earn, the last dollar you earn gets taxed at a higher rate, right? So maybe the first, I'm just going to make it up for simplicity, but say the first 10,000 gets taxed at 10%. And the next 10,000 gets taxed at 20%, and the next 10,000 gets 30. That would be a progressive system. If you earned 50, you still pay 10% of the first 10, 20% of the second 10, 30% of the next 10. You add up all of those, that's going to be your total tax liability. I hope that I hope we can maybe get some visuals in there because my description is probably terrible.
Yeah, but at the part is as the more you earn, there's different tax rates applied to those sort of ranges of income. So obviously, once you break through the top threshold, then everything after that is going to be taxed at the, say, top tax rate. I think today at federal level, it's like what, 37, something in that range, right? So, and that's just at the federal level, right? So at the heart, it's the more you earn, the higher levels of your income, those portions that break through the threshold get taxed at different rates, and they're going to be higher, right?
Yeah, I think the maxim is the more you make, the more they take.
Yeah, that's it. Yeah, that's it. So
And
we're
then,
used to income as a W-2 employee, like income, and you get taxed, and whatever's left, then you get to spend, right? So that's where we can shift over to some of the other things.
yeah, so that's a great distinction here. As an employee, your taxes are withheld on your behalf. Okay, so you sign a bunch of forms, and those forms give your employer the ability to say, okay, we're going to take your federal, state. Sometimes, if you're lucky, they'll also do your local. Social Security and Medicare taxes on your behalf, and we're going to send them to the proper authorities on your behalf. And we'll send you a record, a reconciliation about that data at the end of the year. That's your W-2. That's the report that they give you that says this is how much you made, this is how much we took and sent to these places. Give that to your tax person so they can put that in your in your tax in their tax software to figure out your if you owe anything else. So if we shift gears to the self-employed, I believe that's the next one on the lower left-hand side, or small business or self-employed. We're going from trading dollars for hours, hours for dollars, to trading output for dollars. That's what's happening in the self-employed. So you're getting a results-based income. So that can be a contractor. That can be you go start an LLC and maybe you have a storefront and you're selling pastries or something to that effect. Maybe you have a couple employees, but you earn, in a business sense, you earn revenue. And there's either cost of goods sold or cost of revenue that gets deducted before taxes. Then you further have other regular expenses for operating your business. Maybe you have your electricity, you have your internet connection, your computers, or something to that effect. Those get deducted from the bottom line. That's where you pay your taxes, right? So a business owner gets to deduct a bunch of their expenses first that are related to the operation of their business. So the government doesn't think that's fair, that you're taking a lot of risk here. You started an enterprise. So they'll allow you to say, okay, pre-tax, you get to pay all these expenses first. We take taxes out at the end. So they get to spend first, get taxed second, and spend again what's left, if that makes sense.
Yes,
But that,
absolutely.
right? So a business owner, you're going to file a small business, we'll say solo, self-employed type person, might file a Schedule C. Think C is company, small company. And on there, that you're going to list all that information out. At the end of the year, you have to tell the government, hey, here's how much revenue I made. Here are all my business expenses. Here's what was left. And that bottom line flows through to your Schedule 1 or other additional income, which we can go through the forms. It's not as complicated as you would think, but everything gets aggregated to your 1040, right? It starts on one schedule, it might land on another, and then it gets pulled to your 1040. 1040 is like the summary document that tells the IRS and anybody who's trying to look into your financials what happened financially in this past year, how much you earned, how much you paid in taxes, where your income came from. But this is still technically active income. It's probably earned income, right? There are parts of owning a business that can be passive. So passive activity might be, or inactive income might be something like rents. You set it up and then it pays you cash flow over time. It's a really good example. Just cash comes whether you're sick, work that day, or didn't work that day, you're going to get paid the revenue regardless. So if we move to the next quadrant, we have big business, or I forget the name. It's in the upper right. I think it's a B. It's either big business or like you are now not, you're just managing people, right? You have traded your money to buy labor from other people where they are trading their time, their employees. So the B's are buying E's to do their work for them and contracting to the S's so they can get their work done. But the owner is now not really responsible for driving all the revenue. It's a lot like, or the CEO will say, is not responsible for driving all the revenue. They have several other people involved there. Um, and then the last quadrant was the investor. The investor has largely passive, but it's a special type of passive. It's called portfolio income. So typically they receive dividends, interest, capital gains distribution, maybe royalties, something like that. And depending on what they receive, that's considered portfolio income. So active, inactive, and portfolio are like the types of income, and they get treated differently. So an example of portfolio income might be like if you buy something and sell it and earn a capital gain, and it's not a business that you own. It was just like I happened to buy this thing and on one off chance sold it, like eBay, that was a thing back in Facebook Marketplace, and made $1,000 of profit of capital gains. That would get taxed differently. They would say, "How long did you own that thing?" It was if it's is it short term or is it long term? And depending on your answer, again, we get into different brackets and different rates and different top off rates depending on how much money you make in a year. So your ordinary income kind of dictates how much the rate you would pay in other types of income. So your income, your ordinary earned income, can say you either pay 15 or 20% of capital gains, depending on how much you made. And it gets a little bit strange here. You have to use a calculator, but as you have capital gains, it increases, it sits on top of your ordinary income. So I'm going to keep the brackets simple. Let's say after $500,000, you're in the 20% capital gains bracket, right? So if you have X amount of personal income and you sold a house and it was worth this much more, it sits on top of each other to get you in the top bracket in capital gains. That's still taxed at the capital gains rate, but it sits on top of your ordinary income. Yeah, you have to pay attention to I'll call it the tax stack to say what stacks on top of what to get you in which bracket. And that tells you how much it's really, oh man, just hearing myself try and describe it, it's like, no wonder people
Yeah.
are like, this is insane.
Yeah, well, no, and listen, this is where the complications do come in. But using this sort of framework of an employee versus self-employed to a business owner or sizable business owner to sort of more the investor type of a world, it shows you on the left side with the self-employed and sort of employee, there are probably fewer tax benefits, right, with that by and large versus maybe a business owner or investor who's maybe putting up rental properties and housing people. So this is just gives you a frame of kind of where probably more of the tax mitigation strategies would more float to those business owners and small business folks as well as investors because they're trying to incent that kind of activity, right? For folks to employ people, to invest in things, to house people, whatever. So it just gives you a framework to kind of just think about it. Certainly, there's going to be complexities around, like you just described, Joe. But by and large, that is kind of at a higher level where we can spend some time as we go through the series to kind of flush those things out because there's a reason why they want business owners to start businesses and employ people and provide value to the world because the government can't do that. That's not their job. They're not in the business, right? They're not business owners, right? As you mentioned earlier in this conversation. So hopefully that gives you a kind of just a frame of reference. We're going to go diving deeper into these things of how all those different buckets of folks can actually find ways to reduce taxes and legally and do them in a way that is completely within the law and can help you do more with your money. And so I think this was a great starting point to give you hopefully a foundation for kind of why it exists, kind of general strokes around kind of how it's set up and where maybe you might want to start learning more to figure out ways that you can benefit from the tax code as opposed to just paying, right? So, Joe, I really appreciate all your thoughts and wisdom around this. I look forward to kind of future conversations around this as we get into deeper topics. But I think this was a great starting point foundation and sets us off on a great course for getting a little bit deeper into some of these nuances.
Yeah, pleasure to be here, and I'm looking forward to our first in-depth episode. So, cheers to that.
Awesome, Joe. Appreciate it, man. We'll talk soon.
Thanks for joining me on this episode today. I really am grateful for you as listeners to the Perennial Pride podcast. I hope you're getting some tremendous value out of it and hopefully pushing you along your journey to financial freedom. I put this podcast together really to help you get more educated around your finances so that you feel empowered to live the life that you really want. And if you like the content that you heard today or watched, then I would encourage you to go to my website, perennialpride.com. There's tons of other content there. And you can access my book, Wealth Beyond the Numbers. You can buy it there on my website. It's a aggregation of a lot of great tips and tools I've learned to not only build my wealth in my accounts, but build wealth in my life and abundance and joy, and something that has a lot of my experiences in the journey that I've been on personally. Hopefully that can be also of value to you as you sort of move forward. So thanks again for being a Perennial Pride listener, and we'll see you on the next episode.